Okay, there are a few distinct characteristics of an insurance contract. One of them is it's a contract of adhesion. So a contract of adhesion means that usually like one party in the contract has substantially more power than the other party. So in this case, the insurance company has more power. They prepare the contract for the insured. Now, the insured can either take it or accept it. They can reject it or accept it. So that's a contract of adhesion. It's like, hey, this is what it is. Take it or leave it. That's a contract of adhesion. The insured has little to say about the provisions in the parts of a contract of adhesion. So the biggest thing you want to realize is you get the big guy, the little guy, big guy, little guy. Big guy prepares it, little guy can accept it or reject it. We have the insurer and the insured. Okay, that's a contract of adhesion. The next characteristic is that it's an aleatory contract. So it means there's unequal exchanges. So in an insurance policy, in a life insurance policy, what it is the insurance company is going to pay a massive claim, and all the client has to make, the insured has to make is one payment. Okay, so in a life insurance policy, it can be like, hey, for this term policy, you're going to pay $100 a month. If you make one payment and die, we're going to pay you, your beneficiary, whatever many hundreds of thousands or millions of dollars it is for the life insurance policy. Another aspect of it is that it's a unilateral contract. So a unilateral contract means that one party is legally bound to do something and the other party is not really legally bound to do anything. So in a life insurance policy, the insurance company is legally bound to pay the claim if the insured dies as long as they're making payments. But the insured is not legally bound to make their life insurance premiums. If they don't pay the policy bill, if they don't pay the premium, then the policy just goes away. So that's where it's a unilateral. The insurance company is the only one with any legal obligations to do anything. That's pay the claim if the insured dies. The insured, as long as the insured pays their premiums, but the insured is not legally required to pay their premiums. And then the last aspect of it is a conditional contract. So conditional contract means that some conditions must be met before the claim can be paid. This is how it applies to insurance contract. So it means that the insured or the beneficiary typically has to show there was a loss. So they have to show that the death certificate, like the person has to die for it to be claimed. That's the condition. So it requires certain conditions be met by the policyholder. So in this case, I mean, I hate to laugh, but they gotta die, right? You gotta die to get your claim for life insurance. If it's health insurance, it's you have to be sick, right? Or you have to go to a doctor and they have to diagnose you with some illness to file the claim. That's the condition that must be met. You can't get pills for fun, right? You got to have a condition for it. So it's a contract of adhesion, meaning one party has more say than the other. The other one can just accept or reject it. It's a unilateral contract, okay? Unilateral contract just means that the insured is the only one legally bound to do anything. It's an aleatory contract, meaning that the insured is going to exchange something that's unequal to what the insurer is giving. So the insured is going to pay a much bigger amount of money than the insured is going to pay as their premium. And then it's a conditional contract, meaning that certain conditions have to be met for the claim to be paid. So I hope that helps you understand better the conditions of an insurance policy contract.